All right, there we go. Perfect. I'm glad you are here. Welcome to today's webinar. I don't know if I mentioned this earlier, but my name is Brian D'Amico. I'm really excited to be here. I love teaching about credit spreads and generating income with them because over these years, I've seen how much it really has helped people change their lives for the better. And it's one of my favorite trades. They're fun to do and they work. All right, so in this webinar, we've got about an hour today. I will give you everything I can. This webinar is going to be packed with value, packed with content. That's why earlier, if you were here before we officially started, I asked you to have pen and paper. That way you could take notes because I'm going to give you everything I can for an hour. We've got a lot packed into this hour. All the examples and the case studies and everything we're going to look at today is based on the results that we've gotten with our clients. They are real results and real examples. This is not just a trade that we say, this is all based on a back test that we think might work. No, it's real stuff. We've been doing this with our clients for many, many years, and we're excited to be able to show this trade to you today. I think we've laid out this webinar and the trade itself in a way that is easy to understand. And so we're going to build it piece by piece. And then at the end of today's session, number one, I'm going to guarantee that you're going to be able to walk away with very good knowledge of how to do this trade. But if you did want some more help to get more help from us and get results maybe in a faster way, I'll point you in the right direction to get faster results maybe in the next few weeks and actually be placing this trade with your broker and starting to see some results. So if you are ready to go, in the chat box, give me a quick yes. Let me know that you are ready to go. Let's see if you're still alive out there in webinar land. Jay, you're the first one in. Michael, Veronica, Bruce, Tom, awesome. So a bunch of yeses. I told you at the very beginning we were going to start with a poll. I'm going to put this poll up on the screen. Give me just 1 second. And let me launch this poll. And so you should see something appear on your screen with a few choices. I want to get a feel for who's in the room with me today. So in the if you're watching on GoToWebinar, you should have the ability to select one of those choices. How would you rate your experience level with options? No experience? Are you a beginner? Are you an intermediate? Or would you say you're advanced? Just click on one of those choices, and I believe in GoToWebinar, there's a choice that says submit. And then once you do that, I'm going to give you actually about 5 more seconds to do that. So get in there and do it. 4, 3, 2, 1. All right, let me close this, and I'm going to share the results. So if you're watching on GoToWebinar, you're going to be able to see these results show up on your screen. All right, looking at my results, it looks like it's a fairly even mix in the first 3 categories. 6% are in the advanced area. If you are in the no experience and beginner area, don't worry. You're going to be just fine today. Even though we're talking about a multi-leg trade, we're going to be talking about a thing called spreads. You're going to be fine. Intermediate, where you've already done covered calls. Maybe you haven't done spreads yet. That's fine. We're going to be talking about spreads. Now, if you have done spreads, hopefully I think you'll probably learn a little bit more about how to do them, kind of fill in some of the blanks. Now, if you're advanced, I also think you might be able to learn something today on maybe a piece that you missed, or it'll just reinforce something that you have known before. All right, so let me close that up. And for I just want to speak directly to all. There was about 58% of this room who said you were a beginner or had little experience, beginner or no experience. And I want you to write down 4 words for me. All right, 4 words. And the 4 words are, I can do this. These are 4 words that I wrote down when I started to learn this trade. It was very impactful. So I want to transfer that over to you as well. Sometimes spreads can be a little intimidating. I want you to stick with it. I can do this. And if you have a piece of paper, write it at the top and underline it. I can do this. That way you can always look back at it and say, even if you get frustrated with spreads, you could always look back at it and say, you know what, I can do this. And in fact, I should do this. That'd be the next step, is I can and I should be doing this. Why are these trades so very important to learn? Especially as you get closer and closer towards retirement, they become even more important because we all have things like recurring bills, things like a mortgage, a cell phone. You might have a car payment still. Whatever the case, let's say at some point you're not going to have that income anymore from your job, and things like Social Security might not be enough, or you might fear they're not enough, and you might say, oh man, I don't know if I'm going to have enough income. You might have enough to live, right? But you might not have enough to do all the stuff that you want to do. The people we talk to say, they might not have enough to travel and do the things that they really want to do. That's where this trade comes in, because it'll provide that little extra source of income. That way you're not somebody like CBS reported on, where you're over 65 and you still have to go out there and get a job to do the things that you want to do, or even to pay the bills. Right? So if you're in that position, you're in a good spot today learning this trade today. The system that we're going to be looking at today will be a way that you could generate steady income. That's how we can say that, because all the clients that we're teaching to do this trade here at VectorVest, that's what they're using it for. This trade, since it involves, number one, it involves options. And right out of the gate, people hear the term options and they're like, well, is it risky? They say, well, you're dealing with spreads. That must mean it's complicated. And we're dealing with option spreads. And they say, well, only professionals should be doing that. And my answer, of course, is going to be no, no, and no. Right, to all three of those types of questions or concerns. In today's webinar, the things that I want you to pull out from this, in addition to just the trade overall, is that you're going to see that this trade, one of the benefits of this trade is that it'll involve less risk than buying the stock. So if you wanted to go out there and trade things like Target, Apple, Google, Facebook, the Amazon, these stocks that might be good stocks, but they're a little higher priced, you're going to still be able to trade those stocks and take advantage of their bullish moves with less risk than actually buying the stock outright. That also means it'll be less margin required. That has a benefit, which means you'll be able to also place a few more trades. So if you have a medium to a large size account, you'll be able to place a bunch more of these income trades, giving you more chances to generate income. Since it involves less margin, if you have a small account, you could do these. Even if you have an account that's, let's say, $3,000, $5,000, you'll be able to do this type of a trade. Kind of the sweet spot that we work with, probably $20,000, $30,000, $50,000, $100,000. Those are some great sized accounts to be doing these trades. That way you can have multiple credit spreads going on. And like I said a moment ago, more chances to generate income. The other benefit of this trade is 70 to 90% winning trades. And there was a gentleman I talked to yesterday that said the benefit of that is that it builds confidence. When you place a trade knowing that there's a 70 to 90% chance that you're going to have a winner, it just starts to build that confidence for yourself. In today's webinar, we will look at a trade that you can do when the market goes up. That'll be the first trade that we look at. We'll look at a trade that you can do when the market's going down. And I know we're all kind of on pins and needles right now trying to figure out what's the market going to do next, because the market's been going sideways. Well, the trade that we're going to look at, you could do when the market's going up or down. But if the market continues to do this thing where it's going up and down a little bit and going sideways, this trade will still work out. Just always remember those 4 words that you wrote down earlier. I can do this. Here are the objectives of today. Understand the trade. We'll walk through some examples. We'll do some case studies, and I'll give you a checklist at the end. If you want to put a face to a name, that's me. That's Brian D'Amico. That's me. I don't usually wear a suit, but they asked me to wear a suit for that picture. That's me in my suit. All right, here's our entire team in our fanciest outfits. So the reason we put this here is so you know that this is not just some fly-by-night company. It's not just me in some garage out there giving you this presentation. VectorVest as a company, if you're brand new to VectorVest, we've been around for like 40 years. Dr. DeLito started creating the formulas in the mid-70s, and VectorVest became incorporated, I believe, in 1988. I started working here in 2001. So we've been around a long time, educating investors just like you on how to be successful in the market. All right. let's jump right into it. I hope you're ready. Hopefully you got your notebook or your pen and your paper, because we are going to jump right into the difference between what a standard trade is and what an income trade is. First off, a standard trade, also think of it like a typical trade. This is one where you only make money if you are right. You're only going to make money if you are right on the direction. And these are trades that you do virtually all the time, such as just buying a stock. The second type of trade is an income trade. This is one where you can make money whether you are right or wrong on direction. And you might think, how on earth can I make money if I am wrong? It's not often you can make money when you're wrong on something. Well, with this type of trade, an income trade, you can make money whether you're right or wrong. And I want to show you what that's like. This is a standard trade, just drawing it out visually. Basically, a standard trade is a stock is going up and you buy it here. That's a standard trade. A standard trade means you can only make money if it goes up. If it goes sideways, your money's tied up, even though you're not losing money. Your money's tied up, and it's not the best case scenario. So I'm going to put an X there. And if the stock comes down, that's not good. So that's a standard trade. That's 1 out of 3, right? 1 out of 3 scenarios where you make money. So right out of the gate, it's basically a 33% chance, probability of a good scenario coming out. Whereas an income trade, you're still going to find this good stock. A lot of people think, oh man, I'm an option trader. I got to have a whole new way to find my stocks. The answer is no. For these bullish trades, you're still going to find these good stocks with good fundamentals, rising earnings that you're going to use. Instead of buying the shares, you're going to do an option trade on them. But instead of buying the stock here, where the stock is, what you're going to do is you're going to pick a price where you don't think it's going to drop to. And by the way that I teach this is, I want you to think of it as we go through it, I'm going to keep giving you a layer. I call it adding layers to your knowledge sandwich. We're going to start off with a little bit. I'm going to make sure that you understand that part. Then I'm going to give you a little bit more, and then a little bit more. I'm not just going to, that's why I'm not starting out with stock charts and jumping into a brokerage software. I want you to understand the concepts first. That's the way that I teach this, by the way. Going back to what I said a moment ago, you're going to pick a price where you don't think it's going to drop to. Now, we use a thing called probability. That's something you can find with your broker. You could also say, oh, well, here's a level of support, and you'll pick a price down here. I'm just going to pick a random line right here, and let's just say that you don't think it's going to drop there. And you might say, all right, well, how am I supposed to make money by just doing that? The first thing I want you to understand is you're selling something. You're in this case, you're selling an option. I don't want you to get hung up on all the stuff that's happening in the back end, right? All the stuff that might be going on in the back end involved in selling an option. For now, just understand that you are getting paid for selling this option. And in a moment, I'll teach you that it is actually not just a single option, it is an option spread. But we're selling something. And as long as the stock stays above that line, you make money. So if it goes up, you make money. Actually, that's the best case scenario because you typically will make money the fastest when it goes up. If it goes sideways, you can also make money. It might take a little bit longer to make money, maybe a few extra days, because then you're basically taking advantage of a thing called time decay. But if it goes sideways, you make money. Now, if it goes down, you can actually still make money as long as it stays above that line. It'll take a lot longer, but just know if it comes down too far, too fast, then if it goes through that line, that would be a losing trade. So if we just say this is a check and definitely that's a check, and let's just not even count this one. Let's just say this is an X. That is 2 out of 3. Remember earlier, the other trade was 1 out of 3? This one is what, a 66%? So right out of the gate, this income trade is giving you a 66% probability of being profitable. And some of the other things that we're going to add to this will bump that up. That's one of the reasons why we like income trades. All right, so if you could look at a chart like Jim just typed in, he says, I could do this. If you could look at a chart and say, I don't think the stock price is going to go down that far, you're almost halfway there. The other thing that you could also do this when the stock market's going down. Let me just erase all this really quick. We'll look at examples of this in a minute, but you'll just find stocks that are going down and you pick a price where you don't think it's going to go up to. I'll talk more about that in just a minute. Are you ready for layer 2? That's layer 1, just kind of an overview of the trade. Good. Credit spread. The specific type of income trade that we're talking about is called a credit spread. There's actually 2 types of credit spreads. A bull put credit spread and a bear call credit spread. We're going to look at both of those today. Let's start with the bull put credit spread. Because typically the market goes up more than it goes down, and the downturns are kind of more short-lived, and people are more familiar with buying stuff and being bullish on things. This is a trade where we will be bullish, but before I jump too far ahead, this trade some people see this and they're like, bull put credit spread, that's so confusing, and they just kind of give up and they say, forget it, I'll learn that some other year. Well, let's just break it down by the words bull put credit and spread. If you heard the word bull or bullish, what do you think is going to happen? What are you projecting that the market will do in the future? Go up or go down? Let me know in the chat. Like, this is interactive. Do you think the market's going to go up or down if you're bullish? Yeah, Benjamin's like up. Tom, up. James, up. Exactly. So if you hear the term bull put credit spread, you will only do that trade in an uptrending market and on uptrending stocks. All right? You've got to have both. Uptrending market, uptrending stock. This is the trade to do. That's part 1. Then part 2 is, all right, well, what kind of options do I use? It's right here in the name. You're only going to be using puts. You're going to actually sell one and buy one. And we'll talk more about that in a moment. They're actually both are done on the same trade, so don't get freaked out. It's pretty simple. You just kind of click a couple of times with your broker, and it's all done on one trade. You send it off to your broker, and the broker takes care of the rest. Just understand this is only going to use puts. You're not going to touch calls. And then credit, that means you get paid up front. So when you do this trade, it's a credit transaction, which means money actually gets deposited in your account. And that money is sitting there. We are not going to try and keep all of it because eventually we're going to close the trade. We'll have to use some of that money to buy back the trade, to close it. Our strategy is not to try to hold on to all of the credit. We'll talk more about that later on. So far, we've got bull, put, credit, and then the last word is spread. That's just the difference between the 2 strike prices of these puts, the one you sell and the one that you buy. Let's draw this out. Let me get my laser pointer back out. And, oops, let me go back. Let's see if this works. A pen. Now, I don't like the red. I'm going to actually change the color today to how about a bluish? Do you remember our example from before? I just gave you a stock that was kind of going up. And that's kind of what you want. You want a stock that's hitting higher highs, higher lows, and ideally, it's going to be higher than it was a year ago and a few months ago. It's in an uptrend. We have this good stock that's going up. Remember earlier, I said you're going to pick a price where you don't think it's going to drop to. That is going to be the put that you sell. And I'm just going to draw this line like right here. Now, there's specific criteria that you use. There's going to be a probability factor with your broker. Let's just say it's only got a 30% probability of getting hit or 40% in that range. But let's just draw this line here. I don't think the stock is going to drop to there. That'll be sell put. That's the one that you sell. And since you're selling something, you will receive money. I'm going to put a couple of dollar signs here. Now, you might be thinking, well, if I sell a put all by itself, isn't that a lot of risk? Because those of you, if you're in that intermediate category, or it's definitely advanced, you're thinking, well, that's a naked put, Brian. There's a little bit more risk when I do that. And you'd be right. You're selling a naked put. We're not going to do that. This is a low risk trade that I'm teaching you today. So we're not just going to sell a put all by itself. I want you to think about this. You're going to buy some insurance, which means you're just typically going to select the next put down here, and you're just going to buy that one. All right, buy put. That's your insurance. And when you buy something, it costs something. I will denote that by $1 sign, because this is going to be a little less expensive than what you received for this. Think of it this way. You received $2 signs. Let's just say 200. It cost you 100 for the insurance. These two cancel each other out, and you are left with your net credit. That's how it works. That money is then just sitting in your account, waiting for the trade to end, whether you close it or it expires. We don't let them expire. We actually close the trades. I'm jumping too far ahead of myself, but just understand you're left with a credit. Yay, right? Remember, both of these things are done at the exact same time with your broker. You just click, you say, I want to sell this one. You click another button that says, I want to buy this one. And then your broker takes care of the rest. So that's a high level oversimplification, but that's really all that's involved. And if you remember from earlier, the stock could go up and you make money. It could go sideways and you make money. It could come down and you could still make money. But if it comes down and hits this line, that price of that strike, that's where we exit the trade. We're not going to let this thing go way against us. But just remember, you bought this put right here. This is your insurance policy. So even if the stock gaps down to here and it goes way down to here, you don't care, because you have a predefined, so listen to this carefully, predefined max risk, which is limited, a limited risk. Let's look at the difference. We're going to look at the difference between buying the stock, doing just the short put all by itself, and then doing the spread by looking at an exact example. I told you before, this is adding layers to your knowledge sandwich. I drew it out conceptually. Now we're going to look at an example with an actual stock. This is Costco. I know Costco's not trading at $200 anymore. My brother's happy. He works at Costco. So I'm actually a shareholder of Costco, just as my brother is. So we're pretty happy that Costco is not at 207 anymore. It's at like 400 something, right? 420 something. But let's say here's Costco. If you just bought the stock, and let me get my laser pointer back out. If you just bought the stock was trading at 207 according to this screenshot. When I took the screenshot, it was trading at 207. If you had bought the shares of the stock, 100 shares would cost $20,000 and change. And remember, the only way you make money is if Costco goes up. And remember this, you have, in this example, over $20,000 of your capital tied up and at risk. All right, that means while you don't expect Costco is going to drop down to $182, it could. And by buying the stock, you have all this risk. So we want to tighten that up a little bit. Well, let's look at if you just sold a put. If you just sold a put here, some people say, "Oh, I'll just sell the put down here instead. This will be my income strategy." So they pick a price down here where they might not think that Costco is going to drop to, and they say, "All right, by selling that put, I'm going to receive $246." And remember, that is remember our example from before, $2 signs. By selling that one put, you generate $246, but you still have all this risk. Because remember, if you sell a put, you're taking on obligations to buy the stock. If Costco drops down to $185 at expiration, you're saying, well, if I have obligations to buy it at 185. Excuse me, not at buy it at 185. You have obligations to buy it at 205 where your strike is, even though it's trading at 185. Excuse me for the misspeak. Well, that's not good. We want an income trade that does not have all of this risk. What do? That's where the spread comes in, the bull put spread. We want to shrink our spread down to this. How do we do it? If you remember earlier, we bought our insurance. The insurance we buy it the next strike down typically, let's say at 200. This is the insurance policy, and just like any insurance, it does cost money. Think back to our $2 signs here, and this is $121. That's $1 sign. Those two cancel each other out, leaving you with the difference. You have just generated $125 per contract. And it lowered your risk all the way down to this. That's it. So instead of over $20,000 of risk, you now only have $375 per contract. Now, seeing that, you might say, all right, well, I don't want to do just the one contract because $125 is not a lot for me. You can say, all right, well, since I only have a risk of $375, let me do 10 contracts. That way I can generate over $1,200 and my risk is still only $3,700. Think about that. Instead of $20,000, you're still only at $3,700, which is well below the $20,000. Let's look at this on how it could have worked out. The trade date was back here. All right, so that was the trade date back here. Let's say you were bullish on Costco, and in this trade, Costco went up for 3 days. It came down for 6 days in a row. Then it went up for 3 days. It's like a little roller coaster, up and down and up. Well, it only rose 1.4%. If you had bought the stock, you'd be like, oh, well, I just made 1.4%, which is okay, right? You just made it 1.4%. However, if you had done the bull put credit spread instead of making 1.4% on your $20,000 that you had at risk, instead of doing that, you could be like Frank here, where you could make 16% on the amount of money that you had at risk. You see here, Frank, he's actually a member of our coaching group. I told you all these examples. We do these with our clients every single week. Frank here did this trade back then, and he did a bull put spread in Costco. He said he closed it for a net of $955. So his initial credit would have been double that because we take profits at half of the credit. I just want to show that visually here. See this credit back here of $1,250? We would take profits if our net profit was at $625. So Frank here, he made $955, so his net credit would have been like $1,800. However many contracts that would have been, probably about 15 contracts, and his risk would have only been about $5,000. He said, hey, I'm only risking $5,000. I'm going to place this trade. And by the way, we're never going to assume, we're never going to hold on to a trade and suffer max risk. We always close it well before that. Frank here made $955 in 2.5 weeks. And if you think about it, the stock went up 1.4%. So if you had done $20,000, what's like 1% of that? Is that $200? So you put $20,000 at risk to make $200. Frank said, well, I'm going to tie up about $5,000 of my capital. And he made $955 in 2.5 weeks. I'd say that's a little better. Would you? So I guess I'll just ask you, if you could make money even when you're wrong on direction, how would you feel? I'm going to go back to this screen here. This stock, you weren't really right on direction. The stock went up 1%. but you made 16%. You made money even though the stock didn't really go in your favor. So in the chat box, let me know if you could be placing trades and be making money even if the stock is going sideways, not really going up, not really doing what you want. How would you feel? Tom was the first one in. He's like, great. Tim says, LOL, nice. William says, I feel confident. Larry says, great. Tim's like, if I could make money when I was wrong, I'd be so rich. Unfortunately, Tim, I guess that you're meaning you're wrong a lot. Well, then this is the perfect trade for you, right, Tim? Bin says, I'd feel awesome. Veronica, good. Of course I'd feel really great. Yeah, so what you would do is, I see a question come in, well, what do I do to get out of this trade? Well, you just buy it back. You sell it and you say, well, let me buy it back, and you just buy it back at a cheaper price. And you get to keep the difference. All right, so that's a bullish trade. That's a pretty popular trade that you should have in your back pocket all the time. Now let's take a look at what you should do when the market's going down. Again, we will break it down word by word. This is a bear call credit spread. So the 4 words are bear, call, credit, and spread. Bear. Should I ask you? No, I asked you the last time. If you're bearish, you think the market's going down, hopefully. So you're going to place this trade when the market is downtrending, in a downtrending market, and you're going to pick a downtrending stock. Right? Downtrending market, downtrending stock. Those of you who have been with VectorVest a little bit, we use signals here at VectorVest. The first one will be things like primary wave downs, red lights. Those will be the initial indication that the market's in a downtrend. Once we start to get things like a DEW, kind of our intermediate signal that the market's going down, that's when we're thinking, oh man, yes, all right, we're going to start to be more bearish because we got some good signals saying that we are now in a downtrend. That's when you really start to look for bear call credit spreads. As the name implies, it's only going to use calls. Whereas the other trade that we looked at just used puts. This one's just going to use calls. Credit means you get paid up front, and spread is the difference in the strike prices. Let's draw it out. In this example, let me get my pen back out. When you are bearish, you will be looking for bad stocks going down, or just stocks that are in a downtrend. So they could either be doing one of these things. That's ideal, where they are going down. Lower highs, lower lows. That's one scenario. Or you might find stocks that were going up, but then stalled and started to come down. But the key thing is this part over here, where they are in lower highs, lower lows. They're in a downtrend. That's the key. Bad stocks going down. Typically, you're going to find stocks that have bad earnings or dropping earnings, but they definitely need to be in a downtrend. And if you just flip your thinking from what we discussed a moment ago, we're going to have this stock that is hitting lower highs, lower lows. What you're going to do is you're going to pick a price where you don't think it's going to rise to. I just want you to let that digest a second. This market's going down, right? You think it's going to continue to go down. You don't think it's going to go up. But just in case, you're saying to yourself, well, if it goes up, let me pick a price where I don't think it's going to go up too. And you might use things like this area of resistance. That's a popular thing. We're very simple. We just use things like probability. The broker will show you which strikes have a probability of like 30 or 40% of getting hit. But basically, you're going to pick that price. That's the strike that you're picking for the call that you sell. So I'll write that the best that I can, sell call. And if you remember from earlier, that's where we generate $2 signs. You will not just sell a call all by itself. Your broker probably won't even let you do that. That's called a naked call. You're not going to do that. What you will do is buy yourself some insurance and just buy a put right above it. Typically, it's going to be the next strike up. In most cases, it's the next strike up. You're just going to buy a call up here. makes it pretty simple. Buy a call, the next one up. That's going to be $1 sign that it costs you. Remember, those cancel each other out. Leaves you with a little money bag over here. And you're going to, the trade management for this trade is you're just trying to keep half of that. Well, that's almost half, right? You get to keep this half. And then when you close the trade, you're going to have to use this half to buy it back. So you remember, you sold the spread at the beginning. So you're just going to buy it back. You go to your broker and say, oh, you know that thing I sold? And let me just buy it back. And you're just going to use this, ideally, this half to buy it back, leaving you with a net credit of the other half. That's the way Frank did it. If you remember Frank from earlier, he did a trade where he would have received $1,800-ish in his money bag. And then later on, when it became profitable, he got to keep the $900-something. I think it was $955, but $900. And then he just used the other half, the other $900, to buy it back to close the trade. A nice little income trade there. Well, let's take a look. Let's put some numbers to this. This is Facebook. Remember, we talked about lower highs, lower lows. The stock is in a downtrend. You think it's going to continue to move lower. And all you're going to ask yourself is, all right, where the market's bearish, where do I think Facebook is not likely to go? You're going to be looking at this and you say, all right, well, Facebook is at what? 157. I bet there's probably at least one of you out there who's thinking, well, I don't think it's going to go way up here at 200. In fact, let me just change my ink here to white. That way it shows up a little bit better on the screen. You might think, well, I don't think it's going to go way up here to 200. Well, you're probably right. But the way options work is you're going to remember the dollar signs that I drew earlier. This strike price here might be $4 signs that you would, if you sold that, you'd receive $4 signs. The next one might be $3 signs. This one might be $2 signs. This might be 1. This one way up here, you might only get a few cents for that. And you're not going to do income trades if you're just generating cents. Does that make sense? But All right, so you're just like you wouldn't take a job if the person said, "Hey, I'll pay you 10 cents to do this." You're going to be like, "Nah." All right, and you'll move on. All right, so let me erase all that stuff. So Alfred, I see your comment in the chat box. Let's just say this, Alfred. Where do you think Facebook's not likely to go? Look at it. I'll ask everybody in the room. Where do you think Facebook's not likely to go? Remember, you're bearish. And here's the thing. Not for the rest of Facebook's life. How about just over the next couple of weeks? Over the next couple of weeks, where do you think Facebook won't go up to? It's currently at 157. Where do you think it won't rise to in the next couple of weeks? And be reasonable. Don't say 200. All right, so I'm seeing... All right, so Alfred, you said 200. Remember earlier, if you choose 200, I guarantee you it's probably not going to go to 200, but we got to have a little bit of... There's got to be some chance in there that it could hit it, but it's not likely. I guess that's kind of the key word. Keywords. Not likely to go. So so I see some people are typing in 165, 170, even 175 is a possibility. Those are possible, but not probable. How's that? Possible, but not probable. That's what you're looking for. That it's still possible it could happen, but not probable. So let's take this off of here. So based on probability, it's most likely not going to rise above 165. That's where we selected it when we were setting up the trade. And that's where we would sell that call. We received 455. Think back to what I said before. That's basically $4 signs worth. You just got $400 for selling that. You need to have some insurance. So we did the spread and we bought the insurance policy right above it. That cost $310. That's $3, leaving you with a net of $1, $145. Right, $145. Now, just like before, you could do more than one contract and do, let's say, 10 contracts. That would have generated $1,450. Your goal is to walk away from that trade with $725. Let's look at what happened with this trade. Facebook actually did what you wanted it to do. You thought the market was bearish based on market signals. You found a stock that was going down. Well, Facebook continued to fall 7% over the next couple of weeks. But instead of doing a trade like shorting it, right, which has more risk involved, you did a spread which would have generated 20% on the amount of money that you put at risk. Instead of 7%, 20%. All right, and you in the example I gave a moment ago, if you would have placed this trade with 10 contracts and generated $1,450, that means in 2.5 weeks you would have hit your profit target and made the $700 and something dollars. And great question from David. He says, all right, we're talking about gains. Gains is great. Gains is great. How much would you lose if it goes against you? The way that we've been, if I go back, you see this max risk here? It looks higher, right? So right out of the gate, this is a 3-to-1 trade. I want you to understand, we're never going to lose the max. The way we set up a lot of these trades, David, is that if it hits 170, you close the trade. And most of the trades that we're setting up now have a 1-to-1 risk to reward. So if this is set up, I'm not saying this trade specifically is like this, but the way that we're setting up a lot of our trades now, a lot of them are 1-to-1, which means if we're looking to get $700, if it goes against us and it goes back up and it hits oops, sorry, not the 170, the 165. I didn't mean to say 170. If it hits your short strike of the 165, you would lose 700. That's the ideal scenario of when we're trying to set up these trades. And I'm glad you brought that up. And that's a key thing about these trades, David. People would look at that and say, well, how is this going to be profitable over time if I make 700 and when I'm wrong, I lose 700? I wonder if anybody knows the answer to that in the chat. How would you make money over time if you make 700 and lose 700? Well, the answer is in the number of winners. If you remember way back, James, you got it. The win rate. Do you remember way back at the very beginning, we looked at the scenario where you win based on probability 2 out of 3, 66% of the time? Just in the base setup of the trade? Well, that's how you could make money. If you have winners 66% of the time, you could have 700 per win, 700 per loss. We're better than the 66%, and we're going to get that between 70 and 90. You'll see there's a gentleman that we'll talk about later who was higher than that. Like he was at 60 in the high 60s, then he transitioned to about 78%. All right. So David, in the chat box as we go, let me know if that answered your question. Cool. Thank you, David. David says, got it. Quick question. Since I went a little bit longer on that example, if you did have an income stream like that, where when the market's going down, you had an income source, what would be the impact? If you had an income source, even in down markets, what would be the impact for you? If you think about it, what do you do now when the market goes down? Do you watch profits kind of slip away a little bit? Do you go into cash and just kind of wait it out? What if instead you had a way to continue to add these little deposits to your account? Tom's like, I'd have more money. Good way to put it, Robert. Robert says it would be able to replace my capital losses. Yeah, because you might have these long-term positions in your portfolio that are pulling back because they haven't hit your stops yet. This is a way to offset that. Benjamin says, save my retirement fund. How about let me rephrase that, because I don't want to give lofty promises, Benjamin. How about instead of saving the retirement fund, we're going to be able to enhance it, complement it, make it better, patch it up a little bit. Because it's an income stream. It's not going to be an income tidal wave, Benjamin. All right? I don't want you to think, oh man, I'm getting this get rich quick scheme here in this webinar. I don't want that to come across as that. I want you to understand that this is going to be a stream where you're generating some income. It's not like you're going to be playing the lottery and all of a sudden, boom, you just made $1 million. All right? I'm going to go through a couple of case studies kind of quick because I'm looking down at my clock. I took a little bit longer to go through that, but hopefully it was helpful. We're going to look at some case studies. Now, these are trades that we've done in the past. I'm picking these that way you could see what we did in the past, but that way you could see if you're kind of eyeballing things correctly as well. Now, this is the S&P from some time ago, but you're going to, the chart, you're going to still find examples of the S&P today where the S&P does this. It goes down and it goes up. Right? Forget about the price, what the price is right now. I think you can agree that there's times when the S&P is in a downtrend and then goes into an uptrend, right? When it does that, when it's in an uptrend, you're going to want to do a bull put credit spread. Based on this, the S&P is at 2867 in this example. I'm only going to ask this probably this time, and then I'm just going to show you the answers on the other ones. Where do you think the S&P is not likely to drop to? So this line here is 2850. This one would be 2825. This is 2800. Now, of course, if you type in 2400 way down here, you are probably right. I bet it won't go down there. Remember what I said earlier. Pick a price that is possible but not probable. And think in the back of your head over the next couple of weeks, because these trades typically close in the next 7 to 11 days. That's our typical trade length, 7 to 11 days. So in the next couple of weeks, where do you think the S&P won't drop to? Well, I'm seeing a bunch of different prices. Let's see what we did. And as you can see, we had a customer do this as well, Doug. So Doug here says, on Monday, I bought my first credit spread. I just want to be clear. This was his very first one. He didn't really buy it. I want you to understand, he's selling it. He sold his first credit spread. But the key thing is over here. He did 10 contracts. These were the strikes, 27.75 and 27.55. This is what it looks like visually. Look how far down that is. Some of you got it right. You were saying 27.75. I think, who got that? Benjamin, you nailed it. I see 27.50, Larry. You were very close. But look at this. This is the type of trade you could set up. The S&P had not hit this level in 1, 2, 3, 4, 5, like, what was that? 3 weeks. It hadn't hit that level. Even this area of support is above that. That is a beautiful setup on the S&P. We do a ton of trades on the S&P. It's our most popular income trade that we do with spreads, by the way. A few days later, the S&P rose 1%. That's it, 1%. The overall market just went up 1%. Doug typed in, he said, I closed it today on April 5th. His gain was $1,000. So in, like, was it, what did I say, 3 or 4 days later, he closed it for $1,000. That's a nice little income. There was it, in 5 calendar days. 5 calendar days, closed $1,000. All right, let's quickly take a look at a couple more. We got case study number 2. This one is in a downtrending stock. A stock was going down. The stock was at 139. So remember, the stock is going down. You don't think it's going to go up. Where do you think it's not going to rise to? Now, don't say 190 because we want possible, just not probable. So I see 175, 145. Yeah, 145 would be here. 175 is way up here. That we're not, pardon me, you're not going to get paid enough for the 175. So I'm seeing 145, 150, 155, 145. This is what Manoj did. He did a bear call spread on Alibaba. He did the 150, 155. Right, so some of you were saying 140, 145. It was actually above that. Now, he didn't give us too many specifics, but he did say that he generated a credit of 105. So if I get my pen out here, if he didn't tell us how many contracts he did, but let's just say he did 10 contracts, that would be a credit of $1,050. And he's targeting half of that for profits, which means that trade would have been a $525 gain at profits. He later typed in, I'm out of this trade with my 50% of max profits through a profit order. So it automatically closed. He didn't have to do anything. He didn't have to watch the market all day. He had a profit-taking order sitting there with his broker, and as soon as the profits were hit, boom, out. He just made $525. He gets an alert from his broker to close the trade. All right, so that was 50% in 2 days. All right, in 2 days. So he just made the $500 in 2 days. Still with only a risk of, we're trying to set these up 1-to-1, maybe 2-to-1 or 3-to-1, but in that area. All right, so I'm going to kind of skip past a couple of these other ones. I think we just kind of went through the gist of what we're trying to get across here. Now, this one was 1,413 days. Here's one of the things. Remember earlier I was talking about our S&P system? Our S&P system on these credit spreads, it's the most popular trade, not only that we do, but our new clients who learn this system, like you're probably going to start off by doing an S&P system. It's the easiest thing to do. You don't have to go out there and look for a trade. You don't have to look for a stock. You just do it on the S&P. We've found that over the years of doing this, the S&P ranges between an 80 to 90% win rate. For a long time, we were at 87%. So I'm just going to round that up to 90. Typical gain is about a 7% gain on the amount that you risk. So 90% of the time you're making 7%, 10% of the time you would lose 14%. That's just how it works. You're going to, on the losers for this type of trade, you'll lose a little bit more than you make on your winners. But let's do some quick math. Does this make sense? All right, well, if you do 10 trades a month and you win 90% of the time, that means 9 winners, right? 9 winners times 7%, which is not $700, let's say. You make $6,300 on your winners. Your one loser, you subtract $1,400 for that loser. You're still net income of $4,900. Now, I can understand you might be thinking, well, 90% is high. Well, yeah, it's on the upper end. Let's do something more reasonable for this system. And you still might be thinking 80%. 80%? Well, yeah, that's on the lower end for the S&P system. On the S&P, if you only had 80% winners, so 8 winners times $700 is $5,600. If you lose twice, you lose $1,400 on each one. You lose $2,800. You are still net positive for the month. What would an income system like that allow you to do? Where you're net positive over time. I'm not saying you're net positive after your first week, but over time, you're net positive. Because there's a chance your first two trades might be losers, let's say, but you might have 8 winners in a row. What would it mean to you to have an income system that leaves you net positive? Or how's that different than what you're doing now? Yeah, it'd be pretty substantial, right? It'd be pretty great. Yeah, exactly. Larry's like, I'd have more dependable income. Now, Benjamin says he'd party more. So he's actually going to put his address in the chat box so that we could all come over. Right? All right, so let me give you that checklist. Right, this is a checklist that I want you to look at for doing your credit spreads. First is going to be the market direction. Is the market in an uptrend or downtrend? If you're a VectorVest subscriber, the best place to start would probably be our intermediate signal, which is our DEW. Next up is you're going to then select a stock. By the way, if you're thinking, oh man, I don't know how to select a stock, I would suggest you just start with the SPX. That makes it very simple. You don't have to look at fundamentals. All you have to do is say, all right, is the market going up? All right, well, I'll do just the SPX a bullish trade. If the market's going down, I'll do the SPX a bearish trade. That makes it pretty simple for you. So I think it was Alfred earlier said, oh, this might be a little bit difficult. Well, Alfred, let's simplify things. If you have a market going up, you're going to do a bull put spread on the SPX. If the market's going down, you do a bear call spread on the SPX. Then as you get a little bit more experience, then you could start to say, all right, well, the market's going up. Let me do a bullish trade on a good stock. It's basically going to open up more taps of income for you. Then the base thing is when you set up the trade, you're just going to start off by saying, where's the stock not likely to go? Start off by looking at, with your broker, things like the broker will tell you what the probability is for each of those strike prices. And look for an area of like 30 to 40%. Now, there's some things that we didn't have time to get into today, which we do teach in a more in-depth course. Things like position sizing, which also deals with risk management, but setting up the trade, the 1-to-1 trade versus the 2-to-1, the 3-to-1. Those are some things that we also want to look at when setting up the trade, but you're going to start with probability. Possible, but not probable. Next up, after you set up the trade, then you're going to plan things out. We had time to talk about a couple of these today. We take profits at 50% of the credit. We're going to close at that short strike. The thing we didn't have time to talk about today is adjusting the minimized losses. That's a great little tool for your toolkit. That way, if you do have losses, by doing our mitigation strategies, you have a way to cut those losses by like 30% of what they typically would have been. And then placing the trade with the broker. Like I said way back at the beginning, it could be, for a lot of people, it's just as easy as doing a stock trade. You're going to click a couple of times and then send it off, and the broker takes care of the rest. So when you look at these 5 steps here, just take your pen out kind of quickly here and say, what are you good at? Give yourself a check. What do you need help with? Or where are you not quite 100%? And maybe an X there. All right, you have 5 seconds. Don't overthink it. You know in your gut whether it's a check or an X. And then in the chat box, let me know, what did you just find out about your option income system? If you have 5 checks, it's complete. And you should be ready to go, for the most part, to place these trades. For the most part. You might have a couple of things that you want to fine tune. Now, if it's 3 out of 5 or 2 out of 5, there's some things that we need to fill in, right? In the chat box, give me a number. 1 out of 5, 2 out of 5, 3 out of 5, 4 out of 5, 5 out of 5. Tom, you're the first one in. You say 3 checks. All you have to do is type a number in the chat box. I see John says 3. Oh, Steve, congratulations, 5. 3 for Alfred, 4 for Benjamin, 4 for Joe, 4, 3, 5. Good job, Robert. Robert's already got 5. Jay, 4. Well, though, if you do not have 5, I want to give you some action steps to get you to 5. And of course, I want to give you action steps to get you to 5 as quickly as possible. That way you could start to create this income stream for yourself right now. And as I promised you at the very beginning, I gave you everything I could for the past 60 minutes. And indulge me for the next 5, because I want to tell you how to get the best results the fastest. How's that? Right? And we think the best thing that you could possibly do is join our options Paycheck course, which is 7 weeks to income. As the name implies, 7 weeks to install this option income system for yourself. This course, we know it is a complete A to Z system to generate income each month from option trades so that you can trade with confidence and live the lifestyle that you want without that fear that you're going to run out of money. All right. Our base system, that S&P system that I was telling you about a moment ago, is about 3% per month. Some guys who are a little bit more active are ranging between the 5 to 15% per month. For example, I mentioned a gentleman named Joe earlier. He wrote us an email and he said that he took the Paycheck course, and over the past 10 months after writing this, he was very active. He did 350 trades. He had a 68% win rate, 239 wins. He made $100,000 in the 10 months after he took the Paycheck course. Now that should help with retirement. All right. Now he said he got better and better over time, basically. And you can see here, what was more exciting is that his knowledge and experience grew, and he profited over $50,000 in the last 6 weeks. And his success rate went up to 78%. Remember, I said we're anywhere between 70 and 90%. He was already up to 78%. All right, so he made $50,000 in that last 6 weeks before writing the email. Let me tell you how we lay out the course. There's 7 modules. We start by building a strong foundation in options. That way you know exactly how calls and puts work. So those of you who have little experience or no experience, we're going to build a nice strong foundation for you right at the beginning. Then in modules 2 and 3, you're going to know how to create income trades that have that 70 to 90% or better success rate. Not better than 90, but better than 70%. Then in module 4, you're going to know how to quickly find and select the best stocks to trade. Module 5, you'll know which stocks make the best option candidates and then how to set up those trades. Module 6, you're not going to be a deer in the headlights anymore. Right? If a trade goes against you, you need to know what to do. You got to be prepared. So that's what we'll talk about in module 6. And then in module 7, excuse me, I got a cough. Module 7, we're going to take you into a broker and show you several examples of how to place the trades with the broker. We'll give you checklists. You just print out the checklists. Those of you who are brand new to this, it's like a little security blanket. You just print out the checklists and you say, all right, fill in the blanks, check off the boxes, and make sure that everything is meeting the checklist before you place your trade. If you're worried about the investment in the course, before I even give you the price, I want to let you know that it's a 100% money back guarantee. You can go through the entire thing. You could take all of the information that we've got, come through all of the training, learn everything we've got to show you. And if you go through the whole thing and you say, you know what, I don't think I learned an income system, we would be shocked because we've seen how many people get results from this course. But if you still want a refund, we'll give you all the money back. Just let us know. We do want to only attract people who are serious about this. Don't just take this and be kind of wishy-washy on this. We want you to only take it if you're serious. When you do this system, you're learning a system that generates 3% per month. That's like 36% per year, if I do my math right. I mean, it doesn't take a lot of time to do it per week either. Like I said, if you're not serious about it, then don't do it. If you think it's a get-rich-quick scheme, don't do it. We don't want you in the course, actually. We want people who are serious about it, who understand that you got to put in some effort to get the results. If you are serious about this and you're ready to do the work and get the results, the Options Paycheck course is perfect for you. You're going to get the entire course. We deliver it live as well as recorded. If you sign up today, you will get the entire thing tonight, immediately. You can start going through the course right now, and then we will start meeting with you live next week. In addition to the course, we're going to give you separate bonus training on how to implement our 2 S&P systems. This is probably where you will start out because you could start placing these trades very quickly. This is probably the very first trade you place because it's so simple. It's one trade type, one ticker symbol, one setup rule, one profit rule, one stop criteria. That's it. Simple and easy to do. Actually, most of the trades we did during that coronavirus collapse last year, where we made like $6,000 in a short amount of time, were S&P trades. I actually taught my daughter how to do this Paycheck system. I taught her the S&P system. All right. You're also going to get 7 live mastery sessions. So if you think about it, you're going to get 7 live sessions where we teach you the content, And then later in the week, we'll get back together and do 7 live mastery sessions. So you're going to get 2 live sessions every single week with us. Now, if you can't make it, don't worry. You can submit questions in advance. We'll answer them, and you can watch the recording. It's not mandatory that you attend. If you can, that'd be fabulous as well. Plus, we'll invite you to a private Facebook community where you can start to get to know all your fellow students. You can interact with us. We'll send you the link tonight. Actually, yeah, we'll send you the link tonight. We'll get you approved for the group within the next 24 hours. Plus, after the course is over, picture this. 7 weeks from now, actually no, 6 months from now, picture you're sitting there and you're like, you know what? I need some help. Well, of course, you could still email us, but our main option income coach, Ron Wheeler, he hops on Facebook once a month to answer your questions in this alumni group. All right? Even if you're not a member of VectorVest, you could be in this alumni group and he'll answer your questions. Tim wanted to know how old my daughter was when I taught it to her. 14. 7 weeks of access to members-only group coaching. All right, this is an awesome bonus. Huge, as some people would say, huge, right? Huge. It's a huge bonus, right? This is where we will invite you to our members-only, our private group coaching sessions that we do with our paid clients. That's where you could watch Ron Wheeler find these trades, set them up, and place them with the broker, all in real time. It's a huge bonus. Plus, if you want to use the same software we do, we'll give you 7 weeks of access to the same software. Now, if you don't have access to either VectorVest or this Options Pro software, we'll make sure you have access to them during the course. All right, having the tools for speed is huge. You can use the tools that your broker provides. We like to use VectorVest and Options Pro to get the work done a little faster. We use VectorVest to scan the market and find the exact stocks to trade. Then we use the piece of software called Options Pro to find the best return, the highest probability, lowest risk. All right? Combined, you can see it's a nice value. But during the course, you'll be able to see, hey, are these tools right for me? So we're going to give you access to them during the course. And then those of you who are brand new to options, we'll give you an option foundation course. This is great for you. That way you can start with this, get a great solid foundation of buying a call, buying a put, selling a call, selling a put. You'll learn the 4 core trades. And then when the Options Paycheck course officially begins, you can hit the ground running. You can start going through this tonight. We had a couple of former students say, right after they signed up for the course, Shun typed in, says, I just took the tips that were taught in the bonus option fundamentals course on buying calls. And I'm going to skip down here. He says, 2 of the winners hit my trailing stop in just 4 hours and already paid for the class in full. Bobby over here jumped right to the bonus modules on the S&P, and he paid for half the course already. All right, so what do you get? What do you get? You get the full Options Paycheck course. You get the S&P Paycheck and all these other bonuses. Total value is over almost $7,000. Here's the opportunity that's in front of you today. We have an entire team here that's going to help you. We're going to roll up our sleeves. We're going to work with a couple of hundred people who are serious about generating income. If you choose to be one of them, together we're going to help you create an option income system in your portfolio, even if you've never had success with options. We'll do this together. So you've spent about an hour with me today. I'm going to show you a price that'll be good basically later on tonight and tomorrow. But I'm also going to show you a price in a moment that if you decide to take immediate action, we'll give you an extra special bonus. First off, if you go to optionspaycheck.com tomorrow, you'll see a price of $9.95. That's our early bird pricing. However, you've spent about an hour with me today. Here's what I'd love to do. Just for you. If you order before the end of today's webinar, instead of paying the $9.95, we'll knock another $100 off of that. It's $8.95. It's even lower than our elite pricing. You just go to optionspaycheck.com There's a link in the chat box. Just click on that link. You'll get the full course, the 1 year of access, the 7 live mastery sessions, access to the software, the S&P bonus, the Facebook group, the members only group coaching, the foundation course. I almost ran out of breath telling you all the things that you get. But the $895, by the way, is only going to be if you register by the time we're done here. All right, so probably about 15 minutes from now. Just ask yourself, what would it cost you not to do this? How much money would you lose learning by trial and error? How much potential profit would you miss out on? Do you remember earlier I showed you Joe? If he did not take the course last October, he would have missed out on $100,000 of profit. How much potential profit would possibly you be missing out on? And then think, how much time and energy would you spend trying to learn this on your own and learning by trial and error? Right? And then just say, all right, well, if I do this and it works, how would my life be different? If I do this and it works, which it does, how would your life be different? Some of you are closer to retirement right now, and you say, or you're already retired, and you say, oh man, it's too late for me to learn this. Well, yeah, the best time to plant that oak tree would have been 20 years ago. So you could be sitting under it now enjoying all the income, right? The second best time is going to be today. It's not too late to prepare yourself for retirement and learn to generate income. So this is one of those days, right? It's one of those deciding days in your life. Is it going to be one of those days where you decide to take action and set yourself up for a secure retirement? Or is it going to be the day that you look back on and say, you know what, I think I squandered an opportunity to create consistent income. I really hope you don't regret the decision you make. Don't miss this opportunity. We really look forward to working with you in class. We've been doing this for a long time. We know it works. Here's all the things that you get. Once again, go to optionspaycheck.com. Get yourself registered before registration closes. Remember, the $895 is only available while we're live on the webinar. It's even lower than our elite pricing. So if you've never taken the Options Paycheck course before and you want the lowest possible price, now's the time to go to optionspaycheck.com. After the webinar, the price will go back up to $995. On next month, 1 week from today, the price will go back, well, not go back to, it'll go up to $14.95. And then registration will close that Wednesday. So don't wait or you'll miss out on a ton of the bonuses, all the live stuff that we do. Go to optionspaycheck.com, fill in your details there. If you know this is right for you and you're joining us, just type 2 words, I'm in. Like Patrick says, I'm already in. Type 2 words, I'm in. We'd love to welcome you by name. Just type those 2 words. I'm going to grab a quick drink. Give me 1 second. Sorry. Throat was a little dry there. All right. The most by the way, I'm going to stick around and answer whatever questions you've got. I know our team has been in the background answering a ton of questions that have come in throughout today's session. All right. The most popular question is, all right, what if I miss a class? What do I have to attend live, and what are the dates? Well, we put together a calendar for you. So we got August and September. Those are when we're holding the live sessions. You see, the first live session is going to be August 5th, but then it's every Tuesday after that, 4:30, same time that we met up today. Those will be where Ron Wheeler will teach you the content of the course. Then later in the week, as you can see there, typically on a Friday, Ron will get back together with you and do what's called a mastery session. And the mastery session is where he says, all right, well, we've already gone through the module. Let's now take a look at the questions you have on that module. We'll look at the homework assignment. As you go later and later throughout the course, you'll start to get into actually running the searches, finding the stocks, setting up the trades, and all in real time. That's why we do it at noon. That way the market is open and you can start to see things in action. All right, so again, go to optionspaycheck.com and fill in your details there. You'll notice when you first go to optionspaycheck.com and if you look on that page, it'll probably say $9.95. But if you click on the register button, I think I could find that page here. This is what optionspaycheck.com looks like. if you hit the register button, you'll notice it brings you to a page. It should show, yep, the discounted rate, $8.95. But that'll go away as soon as we're done here. And then you can see as I scroll down, it'll go to the $9.95 price and then up to $14.95. All right. If you go to optionspaycheck.com, also on that site, it'll have a lot of FAQs about the course, and it'll have a ton of testimonials of people who've gone through the course, and they'll tell you the transformation that they've seen in their life. All right. All right, let me take a look over here at the list here. Where can I get the total schedule? That's from James. Let me go back. This is the schedule. Actually, after you place your order, we will send you an email with all of the details in it. The dates, the times, the links. So you'll have a link to the course, directions to access the course. You'll have a link to the Facebook group. Everything will be in that email. Here it is visually for you. You can see August 5th is when it starts at 4:30. Keep in mind, James, you'll get all of the training via recording immediately. Right, so that is August and September, and then August and September later in the week could be on Fridays. Thank you, Paul just typed into the chat box. He says, nice presentation. Hopefully you guys found it very educational. I try to give everything I possibly can in these. Jay says, thank you for the presentation. You're welcome, Jay. Robert says, I paid. I'm in. Welcome, Robert. If I missed your name, like I was so busy answering some other questions and showing some slides here. If I missed your name, and if you haven't left already, in the chat box, let us know that you're in. We'd love to welcome you. All right. Ben, I did it again. Benjamin, it looks like your question Todd answered your question in the chat about closing out of the trade. So double check that in the chat box. Yes, Benjamin, your second question is you're going to see you say options current prices versus the price you paid. What you'll look at is the spread price, not the individual legs. So you'll look at the spread price of when you open the trade versus what it is now. And like Todd wrote to you, you will enter a profit taking order right at the very beginning. So sometimes it happens where it hits your profit taking order and you don't expect it. And it was a good thing that you just had that order sitting there with your broker, and you just hear this ding with your broker, and you're like, oh, and you get surprised that it just closed. All right, you're welcome, James. Benjamin says, thanks so much for the presentation. You're welcome. My pleasure, Benjamin. All right, I saw a question earlier. Can this be done in a retirement account like an IRA? Most of the time, yes. If it's one that you set up on your own. If it's a company-sponsored retirement account, sometimes they have different rules with company-sponsored ones. But if you just go to like Fidelity, let's say, or Schwab and set one up on your own, you might need to call them and ask them how you could enable. It's usually level 3 options. But if you just give them a call, they should be able to walk you through it. By default, it probably is not set up to do that, but you can. Just give them a call. Sounds good, William? We'll see you later on. All right, well, folks, if you need anything, we also have a phone number that you can call. We'll put that into the chat. It's 888-658-7638. So if you want to talk to somebody, you can give our team a call and we'll let you know. And if you have any broker related questions, we're not brokers, right? We're not financial advisors, money managers. We always say call your broker to get specifics about your individual broker in your situation. All right, so We are not your broker, so just give your broker a call and ask them. Okay. Great question. I see. Is it $8.95 for the 7 weeks? It's $8.95 for the course. You have access. Some of the bonuses are good for those 7 weeks, for basically August and September. Like the software that you get and the extra bonus sessions in the coaching group and all the live sessions, those will all occur during that 7-week period. But you have access to all the recordings for a full year. You have access to to all the recordings for a full year. So you're not in a rush. All right, we have a couple of mics. Mike W. You should get an email from us later on tonight. But like Todd just typed you into the chat box, depending on how much you saw here today, this bonus, the extra discount that you're seeing there on the screen, that would go away. Like our system turns it off after a while. All right. Well, folks, I think what we'll do is we'll wrap up for the evening. If you do have questions after we wrap up, give our team a call. The phone number's in the chat. And those of you who have joined, welcome aboard. If you're still thinking about it, let us know. We look forward to having you in the class, and I hope you have a great rest of your night.